Hey, hopefully you're having a good day. My name's Andy. My channel is Finding Value. This is all financial education. And what I'm talking about today in this presentation is inflation and taxes. I want to make sure that all of you know what game you are playing. And I did some numbers, I did some calculations to show you the game that they play. So I'm going to show you this. This is one of the reasons why, this is the main reason I will say that I set up a portfolio the way I set mine up. So this is more explanation on the why I do it. So I'm going to jump in here, and I think you guys are going to be hopefully a little bit mind blown here. So this is inflation and taxes. And this is the way that I view it. So the ultimate form, I want you to think about risk and stores of wealth or value. Remember, they control the currency, so they control basically every transaction. That's half of every transaction, the dollar or that currency. And I want you to think about taxes, and how that affects your investments. And my question is, how does one protect wealth in this system? And I want to go over all this stuff here, so you guys understand the game that you're playing when you invest. Taxes and inflation and the game is what I call this. What you need to do in order to protect and preserve your wealth and time, you need to know this stuff. So how can you win in their game? Do you buy stocks? Do you buy physical precious metals? What about real estate? Are they just going to tax the hell out of this? Let's look into some of these items, and I'm going to show you the way I view things. So what I did is I took a scenario here. I said, this is what's given. A 15% year over year return is what I put, on this one I did a 12% return. It's 10% inflation, 15% long-term capital gains tax, and I boosted up the state sales tax because it seems like the sales taxes continue to go higher over time. Ours used to be 6%, now it's 8.25%. I said, well, what if it's 12% by 2030? So here's the investment here. I took $1,000 and I grew it at 12% clip. At the end of the 10-year period, you'd have $3,105 at a 12% return. That's what you have. Your profit is $3,105 minus $1,000 is $2,105. That's your profit. They tax that at a 15% capital gains tax, long-term capital gains tax. You're now left with $1,789. But you can't do anything with this money. You have to go buy something with it. And if you buy something with it, you're going to have to pay a sales tax. So after that, you pay a sales tax of 12%. That's $1,575. I discounted, I took this and added your $1,000 investment back because now it's year 2030. And I discounted it back using to a net present value of today's dollars. I used a 10% inflation rate. If you do the calculated math on an M2 money supply, it's been a 10% growth year over year. If you look at Shadow Stats, they have an inflation rate of 9 or 10%. If you look at the Chapwood Index, that's another index that's signaling inflation's around 10 or 11%. So what I'm looking at is I'm looking at a 10% inflation rate. Now at 12% gain, and after you pay taxes of buying everything, and then you discount it back to today, your net present value is actually less than the investment itself. It's $992. So you lost money. These taxes are eating everything up because they're taxing you on the total amount, even though they've got this inflation going every single year. Because when you discount it back, it really screws you to get a today's dollar amount. So it's very hard to preserve your purchasing power because one, you're looking at different tax rates in the future because that's a risk, and you're looking at how they're taking value out of the currency through inflation. So I want to tell you world-class investor returns. Who gets a 20% average return or more or something around there? Jim Rogers did a 45% return in commodities. Peter Lynch, 29%. Stanley Druckenmiller, 30%. And Warren Buffett at 17%. And in my opinion, these are some of the greatest investors of all time's returns. So I don't even know if you can get a 45 or a 30% return year over year. These are the top of the elite. So the Warren Buffett return, I stuck a 17% return in that same calculation here. And What I got is he had a 48% return off $1,000 in a 30-year period, and that's all he got. That's not that great. It really isn't. So, inflation and taxes, there's things that I want you to understand. Inflation drives input costs and operating costs of a company upward. So the cost of mining, or the bottom, what we'll call it, their costs move higher over time because of inflation. Mining companies' margins get compressed unless the prices of the commodity themselves moves higher. So what happens is their costs move up at the inflation rate, somewhat at the inflation rate, unless they have technological improvements and operating efficiencies that get improved. So really, the bottom of these producers, the inflation moves the cost of the commodity higher because of the operating costs of the mining companies. And if you're invested in the mining companies and you're doing it during an inflationary period, the mining companies don't actually make more money unless the commodity they sell increases at a faster rate than their input costs. That's how they make more money. And that's why gold and silver typically outperforms in the beginning of a commodities bull market and underperforms on the back half because natural gas, oil, and all of their input costs outperform on the back half of the commodities boom. So ratio analysis, when you're looking at this, the gold to a commodity ratio, or the Huey to gold ratio. If you look at history, gold, silver companies outperform in the beginning of the cycle of commodities, and they underperform the metal at the end of the cycle. It's best to be in the physical precious metals and royalty companies who are not subject to input costs of inflation. That is important to understand. So what I have here is a long-term chart of the Huey, which is a gold mining index, to gold. Gold, the yellow, this is the gold price here as it goes up and down. This is your Huey to gold ratio. When this ratio is increasing, it means that your stocks are outperforming gold. So you want to be in the mining companies during this outperformance. Then you swap to gold as they underperform the price of gold over time. So from the 2000 to 2011 bull market in gold, you only wanted to be in the mining stocks from 2000 to 2004. And that's the beginning of 2004. So that was only a 3-year, 4-year period in the beginning. Then you wanted to swap your mining stocks back to the metal itself. That's how you wanted to play it. Again, that's what we're probably looking at going forward. We're down here. Remember, I didn't create this chart here. I'm just simply presenting it. But we're going to move this, we're going to ride this thing higher. We're at 0.16 right now. We're way down here still. We want to ride this thing higher somewhere in like a 0.5, 0.6, 0.7, 0.8 range up here. And then we want to sell and move our profits to gold or silver or some bullion. That's what the plan is. Because of the input costs increasing faster than the rate of gold and silver. And that is what in a commodities boom market happens. The oil to gold ratio compresses against gold. The natural gas to oil to gold ratio compresses. Everything compresses, and all of their input costs of the mining companies cause the mining companies to underperform the metal itself. So physical precious metals ratio style. How to work outside the system and make real gains irrespective of inflation, deflation, and taxes. Is there a way to do that? And I'm gonna step through something. I'm gonna step through a precious metals plan based off of precious metals ratios. So I'm gonna show you a chart here. This is gold to palladium ratio. It was exceptionally cheap in the early 2000s. This is 2002, 2003, 2004, in this range in here. This is 05. So in this area here, it was extremely cheap. So what I would recommend is whenever you have a cheap ratio like this, you want to dump into this metal and buy that and accumulate that physical precious metal all when it came through here. You want to, right where that whole entire circle is, you want to be buying and buying and buying, which is under 1. You want to buy all through here. So let's just say in that time period, it went below 200. It was like 150 to 210. I said the average cost between this is 200 an ounce. Let's say you bought $20,000 of palladium. at a $200 an ounce average price, that's 100 ounces of palladium. So you own 100 ounces of palladium at that time frame because the ratio is saying that palladium is cheap. Now I've got other ratios. Every single ratio to palladium at that time frame in 2001, 2002, palladium was cheap in relationship to gold, platinum, silver, and it was cheap to all three of those. So it was a buy for all three. You just buy the palladium. So we did that. Now, over time, you can see that this is the palladium to silver ratio. We bought it down in here. But looking at history, palladium has gotten up to the 140, 160 an ounce range in history. So we can see that palladium's outperforming silver here coming up. And I did another ratio chart real time. This is one in 2020. It got all the way to 160 here. This is where I would have sold my palladium, which I did sell my palladium. Now, if you swapped your palladium to silver, because palladium's expensive and silver was cheap in this time frame, it was very cheap during this time frame. If you had swapped it, this is what would have happened. So we would own silver now. We would have swapped our 100 ounce of palladium for silver. In this area here, let's use 160 as an example. Even though it went a little higher, I'm just going to say 160. We now own 100 times 160 is 16,000 ounces of silver. Our $20,000 investment in 2002 to 2005 is now worth $432,000 today if you want to look at it from a dollar perspective. That is a return of 20% per year if you look at that return. Now, let's say we chose palladium because silver was difficult to get during that time frame and you chose platinum. So I actually swapped my palladium for platinum in this area right here when it was over 3. So I said, okay, let's use 3. So we own platinum now because we swapped our 100 ounce of palladium for platinum. We now own 300 ounces of platinum. Our $20,000 investment in 2002 to 2005 is now $315,000 today. Our return is 18% per year. So my return could have been 18% or 20% depending on which one I swap to. That, when going back to this, makes me actually an elite investor. I am outperforming these guys and it wasn't too hard. It's very easy with the lowest risk precious metals in the world with less risk than cash. So stock market returns to match. In order to have a stock return the same as our precious metals investments, you need to add another 1.5% return per year to match our modeled investments in precious metals if you are in a taxed account. So, and it may even be a little bit more than that if you discount it all back, depending on your inflation rate. So you're going to have to earn a 19.5% return to match my 18% return on platinum. Just an FYI, you have to have a better return than Warren Buffett to beat me on my super low risk investments. So what's cheap now? Platinum and silver are the cheap ratio bets at the moment. Platinum is extremely cheap. Physical platinum. Both of these metals are expected to support the green energy movement. They have massive future deficits in these metals projected out in the future. Some of these are a little ways away. Some are coming up very soon. And we don't know the exact deficits because things are progressing so quickly in terms of technological improvements and developments and where all these metals are being used at, that I think it could be very close, near future is what I'm talking about. So I'm not sure if we can even mine these two metals in the quantities they want to use them in the future. I don't even know if they can do it. So I think they're excellent, excellent bets. So, in my opinion, you need to beat the physical precious metals bets that I'm presenting here because they are risk-free bets. You don't have humans. I don't know how the hell you tax them, etc., etc., etc. How much risk do you need in order to take and beat a 20% return using ratios? How much risk do you have to do? I mean, you're going to have to beat this. By beating silver, if I moved that into silver, I'd have a 20% year-over-year return. I don't know if you can beat that in the stock market very well. It's hard. Most world-class investors barely beat this over the years. Precious metals will account for all of this money printing and inflation over time. They always will. So what happens is you've got these guys that want to tax the hell out of things. They're printing money like hell. That's another tax. That is inflation. You're having inflation push these things forward. If they see people making lots of money, the governments, they're just going to tax them more. So now you've got a risk of more taxes. You have a risk of more taxes even on your investments. Biden's wanting to tax wealthy individuals more and more on their investments. I think in the future, you're going to see higher sales taxes. You're going to see higher taxes all across the board for everything. That's my guess. So how do you maintain just the purchasing power for retirement? If you have to take massive leverage and risk in order to get a 20+% return, you'd be better off playing the ratio game in precious metals outside the system and saying, you guys go play your dollar game, I'm going to go play my game. That's one of the major reasons why I hold so much outside the system. So you guys can play this game. You can go in Roth IRAs to put it in tax protected accounts. I highly recommend that. That's about where I put all of my investment money, is in tax protected accounts. I have very little in individual accounts where it's taxable. So I just wanted to make sure everybody understands this. A 12% return, you're basically just treading water at best. And a 17% return, you're Warren Buffett getting that return, and you're barely making any progress anyway. They're taking it all in taxes. So hopefully you guys just understand this, take it into consideration in your investments, and hopefully this doesn't crush your day knowing this information. If you guys like this content, click the thumbs up. Appreciate you guys listening. This is Finding Value. Thank you.